So the Chinese stock market has just cratered on its worst day since 2008. Until I came to edit this video on the 16th of March, just 2 days after the crash, to only come on to realise that stocks are now up on the biggest bounce back since 2008. So what on earth has caused all of this chaos in the stock market? Well, to address the problems in China, it makes a little bit more sense if we actually talk about how they became the economic powerhouse which they are today. And that comes down to one word, which is globalization. The process of interaction and integration among people, companies and governments worldwide. It's pretty much what connected China to the rest of the Western world, which facilitated a rapid period of expansion over the course of the past 2 decades. Throughout the late 90s and the early 2000s, China's GDP grew consecutively at an unprecedented growth rate. Western companies wanted to make use of superior manufacturing capabilities, allowing them to reduce costs whilst increasing their output. And as a result, in this uplift in demand, China became an economic powerhouse, climbing the world ranking of economic GDP at an absolutely rapid rate, overtaking France, the UK, Germany and Japan to become the second biggest economy on the planet. But all of that came at a cost. Economic expansion didn't just come out of thin air. Trillions of dollars of investment was required in order to build infrastructure, real estate, factories, schools, transport and shipping docks in order to facilitate such a high level of growth, which is where we arrive at today, which is potentially the beginning of the downfall of the Chinese stock market.
We are seeing the bearishness when it comes to Chinese stocks or Hong Kong stocks.
Hong Kong shares of dual-listed Chinese companies saw yesterday, this was happening, they fell sharply overnight after fears re-emerged of potential delisting.
It really isn't looking good for the investors who are currently bullish on Chinese stocks. Stock delistings, economic sanctions, links to Russia are just a few of the reasons why there's such a risk-off sentiment for Chinese stocks. But whilst we'll talk a little bit more about that a little bit later on in the video, first I wanted to discuss why myself, amongst many other conservative investors, are very concerned about China. And that comes down to their level of national debt. We're all too familiar with national debt over in the Western world. The UK, along with the US, aren't exactly fantastic at managing money. And it just so has it that China aren't great either. But having said that, it's not necessarily a case of government debt, because in actual fact, debt only sits at just 66.8% of total economic GDP, which, to give you guys a benchmark, if we look at the US government debt, it sits at 120% of economic GDP. But where the problem lies is the total national debt of China, which includes private organisations as well as the government too. Because as of right now, it's clear to see that China love borrowing money, with their current debt to GDP ratio sitting at 300%. Now, of that 300% of a debt to GDP ratio, 159% of it is accounted for with $27 trillion worth of corporate debt, which is almost 60% higher than that of the global rate and nearly double that of the United States. And of that corporate debt, it's the construction and engineering sector, where 92% of firms have a high level of indebtedness. But what exactly does that mean? Well, it means that a company's free cash flow is less than 12% of their total debt, which in simple terms means they have an absolute ton of debt with not much cash in order to repay it. It appears that many of these companies have been absolutely maxing out their credit lines and leveraging themselves through the roof, and you only have to go onto Wall Street Bet's community forum in order to find out what the impact is when you leverage yourself too much. But inevitably, in order to keep up with all of this economic growth and expansion taking place, the construction and engineering sector needed to continue to borrow money at pace in order to keep up with the level of economic growth and to continue to build infrastructure. However, it seems like they overestimated the requirement for real estate, and as a result, China have a number of deserted cities full of big buildings which are unpopulated and unused.
Traffic lights flash with no traffic in sight. The neon lights are on, but nobody's home. These are China's ghost cities, sprawling, empty spaces, just waiting for one thing: people.
One of these ghost cities is in a place called Kangbashi, where in the early 2000s the city was built to house 1 million people. However, the project was quickly scaled back to only house 300,000 people, and as at 2016, less than a third of the homes were occupied. Now, due to this wide-scale under-occupation in China, it reportedly has 65 million empty homes, which is enough to house a population of France, which is where lies the huge problem. In order to create these cities, which are now just simply ghost towns, it required trillions of dollars worth of investment. But with there being no demand for these buildings, that's a hell of a lot of outstanding debt with no mechanism to pay for it. And with China now having a housing market which makes up 29% of total economic GDP, it's massively reliant on its properties in order to generate economic value. However, China is now massively exposed to a property market that's teetering on the edge of default and potential collapse. Now, the reason why I say that is because one of the biggest Chinese property developers is a company called Evergrande Group, which you possibly may remember hearing about late last year. The company have a whopping $300 billion in debt, but is now struggling to pay it back. They recently missed a $1.2 billion interest payment on an international loan, and as a result they've gone on to have $157 million worth of their assets frozen. And with the Chinese property market currently contracting, with residential sales plummeting alongside home buyer confidence, and with home sales values dropping 16.3%, these big construction companies could certainly be in trouble. Strapped for liquidity and no way of repaying these absolutely massive loans which they have, certainly sounds like another huge debt crisis playing out over in the Chinese market. It's got shades of the 2007 financial crisis written all over it, but instead of lending money out to your everyday people for residential property, instead loans have been provided to big corporations in just as much as a reckless fashion. But if you thought that was bad news, well, we're only just getting started.
China will face harsh consequences if it aids Russia in its invasion of Ukraine. It comes after US officials told a number of newspapers that Russia asked China for military equipment. The Chinese Foreign Ministry says it's fake news and US disinformation.
Fake news or not, China was certainly hesitant to condemn the actions of Russia, and now it seems pretty questionable that China have been linked to the potential support of the Russian military. Now, whilst Chinese ministers have certainly highlighted that they will not play a part in the crisis, it has once again raised concerns as to whether investors all around the world can truly trust the Chinese government. After all, it would be a huge risk to invest in any country that had any glimmer of chance that they would potentially support Russia and Vladimir Putin in his attempt to take over Ukraine. And as a result, the simple fact of the matter is, investors have very quickly moved away from Chinese stocks. And to top it all off, March 2020 could be striking again.
Long queues forming in cities across Jilin province as residents flock to get tested for COVID-19. The more than 10,000 cases recorded nationwide in the first 2 weeks of March far exceed previous outbreaks. But China's still working to drive those numbers down.
You really couldn't write it. From a debt crisis to a property bubble, right the way through to potential economic sanctions, along with the outbreak of a new variant of the virus. It's like the causes of the past 3 market crashes all wrapped up into one. And as you'd probably expect, the Hang Seng Index hasn't been performing all too well, with it being down 36.5% in just the past year alone, which certainly brings it close to being on par with some of the major stock market crashes which we've seen over here in the UK and the US too. But what does all of this mean for investors in Chinese stocks? Is now the time to throw in your towel and realise your losses, or is now the perfect time to buy the dip? After all, if you thought US tech stocks were trading on sale so far this year, then you should probably take a look at Chinese tech stocks. You've got the likes of Alibaba trading at a price to sales ratio of 2.2, Tencent at 6.1, JD.com at 0.81 and DD at 0.68. There really is some tremendous value over in China right now, especially compared to the US and the UK. But I guess a stock is only as valuable as the demand that investors place on it. And with currently very little demand and upbeat sentiment for Chinese stocks, getting a return on investment in the short term certainly doesn't seem all too likely. Although having said that, some investment banks like Goldman Sachs and Credit Suisse are actually optimistic, along with high-profile investors like Charlie Munger, who's Warren Buffett's right-hand man, who recently had this to say about China.
But China is a big modern nation. We invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security.
Now, Charlie has certainly put his money where his mouth is, and he's actually doubled down on his position in Alibaba. increasing that position by 300,000 shares, as we can see in his most recent 13F filing. So I guess the overriding question, what's it to be on the Chinese stock market? Steer clear as a result of regulations, potential future lockdowns and a massive debt bubble, or use this as an opportunity to buy the dip on some stocks that are trading at a very good value? Be sure to let me know what your thoughts are down in the comment section below. But before you go, I hate to be the bearer of bad news, but if you thought what was going on in the Chinese stock market was bad, well, it's not looking great either for the US or the UK stock market. So if you are an investor in any of those markets, then you're definitely going to want to check out this video here to find out what's going on and how it could potentially impact your investment portfolio.